Why do wealthy families create three separate companies when they could just own everything directly? The answer comes down to four key benefits that this structure provides. First, liability isolation keeps lawsuits from reaching their assets. Second, tax optimization allows income to flow between entities in the most efficient way. Third, privacy protection makes it more difficult for outsiders to trace ownership. Fourth, inheritance planning lets them transfer ownership through shares instead of retitling physical assets. These strategies require proper implementation and professional guidance to work effectively. But when you start looking at how wealthy families actually structure their holdings, you'll discover something that doesn't match what most people expect. Hi, Kane here. I've been in the housing industry for nearly 20 years. I started as a theater grad with nothing and now own several properties throughout Ontario. Be sure to watch my biography video to see my story. Also check out the references in the description below to get an idea of where I pulled the research from. If there are any discrepancies, please let me know. Before setting up any legal structure, be sure to consult with a lawyer and accountant, as this video is solely for educational purposes and not to provide legal information. Without further ado, let's begin. Most people think rich families just buy things and put them in their name, but that's not how it works at all. When you look at public records for a billionaire's mansion or business, you won't find their personal name anywhere. Instead, you'll find strange company names that seem to have nothing to do with the actual owner. You might see Mountain View Holdings LLC owning a tech mogul's estate, or Pacific Asset Management Corp., or a numbered company controlling what looks like a family business. This creates a puzzle that most people can't solve, even when the information is right there in public records. The documents are public, but the trail goes cold because wealthy families use legal separation between ownership and control. They place valuable assets like real estate, investments, or business interests within various legal structures such as trusts or limited liability companies. This fundamental separation makes it difficult for external parties to trace who truly benefits from or directs the wealth. The three-company structure works like a shell game, but instead of hiding a ball, it's hiding ownership and control. Each company has a specific job. One controls everything, one runs the business, and the other owns the valuable stuff. The holding company sits at the top, pulling all the strings without getting its hands dirty. It never touches customers, never signs contracts, and never handles money directly. Yet this company that does nothing controls everything worth millions or billions of dollars. This setup serves legitimate business purposes for liability isolation. For instance, an Ontario resident might establish one LLC to manage their real estate holdings in Alberta and a separate LLC for their business activities. Each of these LLCs maintains its own bank account. This segregation prevents liabilities incurred by one entity from spilling over to another, protecting each business venture from the risks of the others. The strategy works because the legal owner is an entity, not the person being sued. When you use trusts, the trust itself legally owns the assets and the individual is the beneficiary. This separation of legal ownership from beneficial control is key to understanding how billionaires manage their wealth. While the individual can still direct the management of these assets and benefit from their appreciation, they do not legally own them. This makes it more difficult for creditors to seize these assets, though these protections depend on proper implementation and following legal requirements. The three-layer system creates substantial protection where each wall defends the others. Multiple distinct LLCs for different assets or business operations create barriers for any party attempting to trace ownership or pursue legal claims against an individual's wealth. Each entity maintains separate assets and liabilities, with legal barriers that prevent creditors from accessing assets in one entity to satisfy claims against another. While these structures provide significant protection, when properly managed, they require ongoing compliance and aren't absolute shields against all creditors. Understanding how each layer functions reveals why this division of responsibilities creates such effective protection. Let me examine how this division of responsibilities actually works in practice. The three companies work together like a well-trained team, but each one has a completely different job. The holding company never touches customers, never signs contracts, and never handles money directly. It stays completely removed from all business activities that could create legal problems. The holding company exists only to own shares in the other two companies. It acts as the central control point without getting involved in anything that could lead to lawsuits or financial trouble. This company that does nothing controls everything worth millions or billions of dollars. The holding company owns the shares of both the operating company and the asset company. This means it controls all the decisions without taking any of the risks. When the family wants to make changes, they do it through the holding company. The holding company can tell the other companies what to do, but it never gets its hands dirty with the actual work. The operating company does all the messy work. It hires employees, deals with customers, and handles all the daily headaches that come with running a business. Every contract gets and customer complaint goes to the operating company. All the revenue flows through the operating company first. This company takes all the hits when things go wrong, like a shield protecting the valuable assets behind it. When someone gets hurt at a business, or when employees file lawsuits, they can only go after the operating company. The operating company bears all the operational and legal risks. It handles payroll, manages vendor relationships, and deals with regulatory compliance. All these activities create potential liability, but the operating company absorbs these risks so the valuable assets stay protected in a separate entity. The asset company owns the expensive stuff like buildings, equipment, and patents, but never uses any of it. This company holds all the valuable property, but stays completely separate from business operations. It never interacts with customers or employees. The asset company just owns things and collects rent, lease, or licensing payments. Instead, it leases everything to the operating company, creating a landlord-tenant relationship within the same family structure. The operating company pays monthly rent to use the building. It pays licensing fees to use patents or trademarks. These payments move money from the operating company to the asset company in a completely legal way. The intercompany lease agreement makes this arrangement official and documented. These arrangements must serve legitimate business purposes and be properly documented to maintain their legal effectiveness, with rent payments set at fair market rates to maintain legitimacy. When lawsuits happen, they can only attack the operating company because that's the only one they can find or prove wrongdoing against. Lawyers look for the company that actually harmed their client. The operating company is the one that hired the employee who made the mistake or maintained the property where someone got hurt. The asset company never touched the customer, so it stays protected. This division of labor means that no single company ever has both the valuable assets and the legal exposure at the same time. The operating company faces the lawsuits but owns very little of value. The asset company owns everything valuable but never creates liability. But how well does this protection actually hold up when aggressive lawyers start attacking the structure? The real test comes when lawyers start digging and courts start demanding answers. A luxury hotel guest slips and falls, then decides to sue for millions in damages. The guest's lawyers will go after the hotel company, but they'll quickly discover that this company doesn't actually own the building, the land, or any valuable assets. The lawyers find the operating company that runs the hotel. This company hired the staff, maintained the floors, and interacted with the guests. But when they look at what this company actually owns, they see very little of real value. The operating company might have some cash in bank accounts and basic equipment, but the big-ticket items are safely locked away in the asset company. The building itself belongs to a completely separate asset company. The land under the building also belongs to this company. The expensive furniture, artwork, and fixtures all belong to the asset company. The operating company just rents everything from the asset company through monthly payments. Even if the lawsuit succeeds and destroys the operating company completely, the family still owns the building through a separate entity. The court can take everything the operating company owns, but that doesn't include the most valuable parts of the business. The operating company basically has no real assets to seize. The lawyers might win their case, but they can't touch the real estate or major assets because those belong to a different legal entity. The holding company remains untouched because it never interacted with the guest and has no direct liability. The holding company never hired the employee who failed to clean the floor. It never signed the contract with the cleaning service. It never made any decisions about hotel safety. The holding company just owns shares in other companies. This same protection works for tax audits and business debts. When tax authorities audit the business, they focus on the operating company's income and expenses. The rent payments from the operating company to the asset company are legitimate business expenses. The asset company reports this rental income on its own tax returns. Each company files separate returns and faces separate audits. Courts have tried to break through these barriers, but properly structured systems usually hold up under legal pressure when proper formalities are maintained. Judges look for evidence that the companies are fake or that the family didn't treat them as separate entities. If the companies have separate bank accounts, separate tax returns, and documented business relationships, courts generally respect the legal separation. However, these protections require ongoing proper management and compliance with legal formalities to remain effective. The three-company model creates multiple firewalls that prevent any single problem from reaching the family's core wealth. One lawsuit can't destroy everything because the valuable assets stay protected in entities that weren't involved in creating the legal problem. While these structures provide significant protection, they're not absolute shields, and sophisticated creditors may still find ways to challenge them. But the defensive benefits represent only part of what makes this structure so powerful for wealthy families. The structure actually helps create more wealth through legal financial engineering. When the operating company pays rent to the asset company, this creates a tax-deductible expense that reduces the operating company's profits. The operating company can write off these rent payments just like any other business expense. This lowers the amount of profit the operating company reports to the tax authorities. Meanwhile, the asset company receives rental income that can be taxed at different rates or in different jurisdictions entirely. The asset company might be set up in a province with lower tax rates. It might qualify for different tax treatments because it only owns assets and doesn't conduct business operations. The family can time when the asset company reports income or takes depreciation on its properties. These tax strategies must comply with CRA requirements and serve legitimate business purposes to maintain their effectiveness. This income shuffling allows families to smooth out their tax burden across multiple entities and multiple years. If the operating company has a great year, it can pay more rent to the asset company. This moves income from the high-earning operating company to the asset company, where it might face lower taxes. The family controls when and how much income flows between the companies. When it comes time to sell or transfer wealth, the family can move shares instead of retitling physical assets like buildings or businesses. Transferring ownership of a building requires new deeds, title searches, and recording fees at the office. You need appraisals and inspections. The whole process takes weeks or months and costs thousands in legal fees. Transferring a 10% stake in a holding company is much simpler than transferring 10% ownership of a hotel building. The family just signs over shares in the holding company. No deeds need to change hands. No title companies get involved. The building stays owned by the same asset company. Only the ownership of the holding company shares changes hands. The structure also allows families to sell just one layer while keeping the others, like selling the hotel operations while keeping the building. A buyer might want to run the hotel business but doesn't want to buy the expensive real estate. The family can sell the operating company that runs the hotel while keeping the asset company that owns the building. The new owner becomes a tenant paying rent to the family's asset company. This gives families options when they want to cash out part of their wealth. They can sell the business operations and keep collecting rent. They can sell the building and keep running the business somewhere else. They can sell part of the holding company to bring in investors without giving up control. These financial advantages compound over generations, allowing wealthy families to keep more of what they earn and transfer it more efficiently to their children. The tax savings add up year after year. The easier transfers mean less money spent on lawyers and fees. The flexibility to sell parts of the structure creates more opportunities to generate cash when needed. These strategies require professional guidance to implement correctly due to their complexity. Understanding these advantages reveals why wealthy families approach asset ownership so differently from everyone else. This systematic approach to wealth management explains why billionaires rarely face financial ruin despite constant legal challenges. The three-company model proves that the wealthiest families think about ownership completely differently than most people do. While others focus on what they own, wealthy families focus on how they own it and who can reach it. They understand that direct ownership creates direct liability. When you own something in your personal name, anyone who wants to sue you can go after that asset. Setting up basic asset protection strategies cost between $10,000 to $50,000 depending on complexity, though more sophisticated international arrangements can cost significantly more. This seems expensive until you realize that one lawsuit can cost millions of dollars. These strategies require specialized professional guidance and work best when implemented proactively before any legal threats arise. Start thinking about your own assets and ask yourself, what would happen if someone sued you tomorrow? Build out your team of lawyers and accountants. Ensure that they can work together well to create a structure that will fit what you need to do to preserve your wealth for future generations to come. If you enjoyed this material, be sure to watch my next video on how poor people versus how rich people think.